The US economy isn't just slowing, it's steering straight into a storm. And this isn't about a simple tariff war anymore. We're talking about a full-blown financial trap. A collapsing dollar, soaring tariffs, a global investor exodus that could shake the markets to their core. Foreign capital is already fleeing. American consumers are feeling the squeeze. And what's most alarming, this isn't some unavoidable external shock. It's a crisis of our own making. The dollar is spiraling downward. A radical tax proposal is looming. Together, they could trigger a $31 trillion sell-off. The warning signs are screaming red, and yet the administration remains locked in spin mode, denying the severity while the economic ground beneath us starts to crack. So here's the question that's becoming harder to ignore. Can the US economy survive another 12 months on this path? Buckle up. We're about to unpack two catastrophic policy decisions threatening your wallet, your investments, and America's financial foundation. Things aren't just heating up, they're boiling over. This isn't a rough patch, it's a perfect storm. Two self-inflicted wounds are colliding in real time. First, the dollar's rapid decline. Then, a tax proposal so aggressive it's sending shockwaves through global markets. Together, they're eroding confidence in US assets and dragging down demand from the very investors who prop up our financial system. The signs are everywhere. Global investors, watching the US with surgical precision, see the cracks forming. Even if US stocks show gains, a weakening dollar wipes those away. Year to date, the S&P 500 might be up 2%, but the dollar has dropped 9%, from 109 on the DXY to below 99. For overseas investors, that's not a win, it's a loss. And for American consumers, it's even worse. Imports are now at least 9% more expensive. Add tariffs, and that number jumps past 20%. There's no escaping this hit. Zoom out, and the next 12 months look even grimmer. Major US banks are sounding the alarm, but the administration is still pushing the narrative that all is well. No end in sight for the tariff war means more strain ahead. Analysts are forecasting another 9% fall in the dollar. Investors are already bracing for it, shorting the dollar to the tune of $47 billion. That pressure is building fast, and the market's telling a grim story. It's expecting the Fed to cut rates, and soon. But that brings us to the trap. If the Fed caves to political pressure and slashes rates, the dollar could plunge further. Short-term bondholders would flee, and capital outflows would accelerate. On the other hand, if the Fed stands its ground and the economy stalls, demand for imports could collapse, dragging the dollar down anyway. No easy way out, just hard choices, and each comes with pain. Then comes the noise. Treasury Secretary Bessent is on a media blitz, insisting tariffs aren't inflationary. He even points to a report claiming Chinese suppliers are eating 65% of tariffs. But let's be honest, that's fiction, not fact. The idea that Chinese exporters are silently swallowing tariff costs? There's no solid evidence. In fact, exports to the US are falling. If anyone's absorbing the cost, it's US companies and consumers. The math just doesn't add up. So why the PR push? Because investors are spooked. Since Trump took office, US stocks have underperformed global peers. The capital that once flowed freely into American markets, it's hesitating. And if the dollar continues its fall, more investors will pull their cash. The era of the US funding itself through a steady capital account surplus could be ending. Less foreign money means weaker demand for stocks, bonds, and treasuries. That's a dangerous shift. And then there's the revenge tax, Trump's proposed bombshell embedded in a little-known section of a massive bill. Section 899, the enforcement of remedies against unfair foreign taxes, would impose up to a 20% tax on foreign holdings of US assets. It's not policy, it's retaliation disguised as reform. And it could be catastrophic. Foreign investors currently hold over $31 trillion in US assets. That's not just some number on a spreadsheet. It's the bedrock of our financial system. If this tax passes, demand for US assets could plummet. A 20% tax on foreign exits. That's capital control in everything but name. It would spook markets, crush investor confidence, and potentially trigger a massive liquidation. Here's what that would look like. US stocks could fall 10% almost instantly. The dollar could drop another 5% against major currencies. Treasury yields might spike by 50 basis points, sending interest payments on the national debt surging. And yet the thinking behind it seems to be this. If we can't attract investment, maybe we can trap it. But markets aren't stupid. They see the trap and they'll act before the door slams shut. This is more than policy. It's a game of financial brinkmanship with stakes that include your savings, your retirement, and the global standing of the US economy. Investors are watching. The dollar is wobbling. And the storm? It's just beginning. Stay sharp. Stay informed. This isn't a drill. The real victim here isn't just policy. It's the Treasury. If this plan goes through, Bessent's going to have an impossible task ahead, raising funds in a system already buckling under pressure. This is the kind of short-sighted thinking that gets you a quick headline bump in revenue, sure, but it guts investor confidence long-term. You don't stabilize an economy by lighting the foundation on fire. Even as a revenue tool, it's a flop. The projection? $116 billion over 10 years. Sounds big, until you stack it against a projected annual deficit of $2 trillion by 2033. Suddenly, it's pocket change. Worse yet, this provision might not just underdeliver, it could cost the US $13 billion in lost tax revenue. That's not just ironic. That's catastrophic fiscal mismanagement. Trump's bill doesn't solve the problem. It punts it further down a narrowing road. It slaps foreign imports with penalties, hoping something sticks. But make no mistake, if you're an investor watching this unfold, you're sweating bullets. The ability to borrow is about to tighten. Hard. Foreign appetite for US bonds is not just helpful, it's essential. And with this bill looming, we're risking one of the last stable pillars holding our financial house up. The Congressional Budget Office is ringing the alarm. Trump's broader agenda could pile on at least $2.4 trillion in new debt over the next decade. That's conservative. That means issuing an extra $240 billion in US bonds every year just to keep pace. Where is that money going to come from? Consumers? Businesses? They're already suffocating under Trump's tariffs. In May alone, US Customs collected $23 billion in tariffs from importers and, by extension, consumers. That might cover the bill today, but tomorrow? Forget it. You can't lean on monthly $23 billion windfalls when people are getting crushed at the checkout line. And if this pressure keeps mounting, Americans may simply stop spending. That's the nightmare scenario. Consumers tap out, tariff revenues vanish, and the whole plan collapses under its own weight. Whether global investors stay in or flee will hinge on the health of the US economy. And here's where things get chilling. 70% of our GDP is private consumption. That's our lifeline. And yet, the latest service index just contracted for the first time in nearly a year. Business activity? Lowest in 5 years. New orders? In free fall. Prices for services? Spiking to record highs. So let's stop pretending inflation is invisible. It's right there in the data. Prices are rising. People are buying less. And with consumers already overstretched, we're headed straight into a fiscal expansion we can't afford. Trump's proposed tax cuts are either going to land, or the tariffs will break what's left of US consumption entirely. And remember the aluminum and steel tariffs? That quiet disaster. It's hitting home, hard. Tariffs raised to 50% have driven premiums up by 54%, the highest since 2013. US manufacturers now pay up to 50% more than international rivals just to get the raw materials. That hits everything, from soda cans to Teslas. It's strangling our economy from the inside. Can Trump talk his way out of this mess? Unlikely. He's branded steel and aluminum as essential to national security, which means the price hikes are baked in. Permanent. And here's the brutal irony. He's trying to protect our war-making capabilities, arguing we need our own steel and aluminum to defend ourselves. But the tariffs are weakening those very industries. If we don't rethink this, we won't have the materials we need when we need them. We're standing in the middle of a storm that's converging from every direction. Higher prices. Foreign investors under threat. A tax drag lurking just over the horizon. Ask yourself, would you, as a foreign investor, keep pouring billions into a slowing economy? Especially when your bond returns could be slashed by punitive taxes. This is the pressure point, a falling dollar, asset prices weakening. And the dollar, make no mistake, is the linchpin. If it falls too far, we could see a catastrophic chain reaction across global markets. And signs are already flashing red. Emerging market currencies are rebounding. US interest rates remain historically high. Capital is fleeing. Investors are pulling out of the dollar, reinvesting in local markets. That's why stocks are rising in places like China, Japan, even Europe. Their currencies are gaining ground while US assets take the hit. That's the growing divide. Real gains over there. Real losses over here. And this can't continue without reaching a breaking point. And we're not done. The trade war? It's unraveling again. In the dead of night, Trump posts on Truth Social that President Xi is very tough and extremely hard to make a deal with. Is this a white flag, or the opening shot of escalation? Either way, it signals instability. Resolving the US-China standoff is critical. The last thing we need is a new round of triple-digit tariffs slapped on out of spite. Tariffs that could further rattle markets and send investors running for cover. And during a congressional hearing, Lighthizer let it slip. This was never just about tariffs. The endgame? Reducing the US trade deficit with the world. Once you understand that, the picture becomes terrifyingly clear. This isn't just trade policy, it's a calculated gamble with the dollar and global financial stability. A strategy meant to counter China's rise is now threatening the very core of US economic strength. So here we are. The plan is to zero out the trade deficit, cut Chinese influence, and reclaim American manufacturing dominance. Bold? Yes. Realistic? That's another story. Because right now, it's mostly talk. And that talk is shaking investor confidence worldwide. The big question now, will investors keep pulling out of American assets? Will trade talks with China collapse again? Or will someone finally blink before we tip into a full-blown crisis? Let me know what you think. Stay sharp, stay skeptical, and keep your eyes on what matters. The storm isn't coming. It's already here.